What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. If you're wondering why, well, this whole camera and this whole setup looks very weird. Well, I'm on my knees right now in my bedroom out here in Arizona on vacation. Surprisingly enough, I had to take a COVID test today because one of the people that we were staying with at Dillon's Beach ended up contracting COVID and tested positive. We tested today and we had a rapid test. We came back negative, so I'm happy to report that. Just wanted to show my face here because I haven't shown my face here for quite some time. Let you guys know that you're talking to a real regular person right here. You're watching the Daily Stock Market Brief. Today's date is November 11th, 2020. In today's video, I really want to kind of just help get a good sense as to where we stand right now in the marketplace and then end with a big conclusion as to where we might be going, what we might, be seeing here in the near future. In yesterday's video, we talked about the potential for a melt up and or just a complete breakdown. And really what we've been seeing here is just a lot of uncertainty in the markets. And as we've seen previously, if you follow me on Twitter, awesome. If you don't, go follow me there and or Instagram. I do have a website as well that I built, no big deal, but I built it. It was just really a theme that I added to, but whatever. I'm new to all of this stuff, as most of you already know, and I have a newsletter there, and I plan on putting out some more stuff on that newsletter. So thanks for everyone that's been responding to the email and, saying what's up. I do plan on responding to everybody there. But I've been just a tad bit preoccupied with this whole traveling situation that I've been on this last week and a half. So in today's video, we're going to be talking about a few different things. We're going to be going over some of the sector spotlights. We're going to be talking about indices, some indicators. We're also going to be talking about commodities, yields, and the dollar, and then just kind of wrap up with my overall conclusion. What is this going on right now? Okay, let me just head in. Exit that. Okie dokie. So yeah, let's just go ahead and get into it because I don't want to waste your guys' time here. We're going to start with the sector spotlight, and this is really what did we talk about yesterday? We said, well, energy has been doing so good these last couple of days, and then we started mapping out some resistance areas, and we're like, okay, this doesn't look like it might, we might be slowing down here. And what do you know? At the very bottom of the list is energy and materials, the both sectors that we've been kind of keeping an eye on that look like a good opportunity. But I want to show you what's called a relative kind of strength graph. And if you're wondering where I get this from, it's from stockcharts.com. I subscribe there. And no, I'm not endorsing them, but I do use them. And really what I want to show you here is there's 4 different sections, okay? And this is all about relative strength to the SPY, okay, or the S&P 500. And it's taking all the sectors, the sector spiders, and just showing relative strength. So when you start seeing strength in a certain sector or industry, you can start saying, okay, well, this might be improving and this is where I might want to find some stocks to invest in. And it's all about finding opportunities in the marketplace. So if you're new here, I do this show 5 days a week. So we look for opportunities in the market to better help us, make more money overall. And what I want to show you here is, first off, you'll see the head and then a tail. And this is 7-day tail, as I'm seeing, 7 trading days. And what's interesting here is you can see like XLU, this is utilities, and it was right over here about 7 days ago in the lagging area. So we have lagging, weakening, improving, and leading, and you want to kind of watch where the tail is and where it's headed. And the farther up to the corner it goes, it shows that it could be potentially leading up here in the green or improving over here. And what we see with utilities, and the reason why I'm bringing up utilities right now is because utilities is a risk-off type of move. And once we get into the other sector, indices, you'll see what I'm kind of seeing here, why people might be moving into some utilities. So utilities from this lagging area, it's kind of slowly sloping from improving into the leading sector. What's leading right now? Well, interestingly enough, I want to show XLB. That's materials. Materials was here, and then it kind of started weakening a little bit and started moving back up to leading. This is going to be one to watch right here. And we see a lot of other like real estate. We have XLP, XLR, XLV right here as well. And down here is energy, and you can see energy was really lagging for quite some time. That's nothing new here, but we're starting to see it kind of start to improve. So it's a rotation. We're seeing this rotation take place in the markets, and you're probably hearing that on the news, on the media. Where's this rotation going? Well, this is one really good graph to help us visualize what's taking place in the markets. And we'll get more into this in other episodes. So if you don't subscribe, I really appreciate it if you do subscribe, because these videos, like I said, Monday through Friday, 5 days a week, you know the drill. Let's get into the indices. We're going to first start off with the S&P 500. We're going to look at the daily time frames. Okay, we had a wicked reversal type candle here, came back to back test this trend line, and now I'm kind of confused as to is this just messing with us right now? Because now we just back tested and then we gapped up again, which is so interesting because if you don't follow macro charts on Twitter, macro charts was really showing us something interesting today on one of their charts. It was showing us the strength between after hours and in the cash markets, and it had a graph mapped out. I'll try to post it here very soon on my Twitter, but it was showing that just how much more stronger after hours was. And to me, what that resembles is these big gap ups that we've been seeing. A lot of money's being made after hours, and if you're holding overnight, awesome, but also there's not much going on during the cash hours where we just see a lot of chop back and forth, and this is showing a little, it's just illiquid type of market trading during the day. And this is concerning to see all these gap ups because we know what has happened in the past when we have gap. Well, they get filled on the way down very quickly. And right now we had a decent day, right? We're up 0.77%, but it was from another gap up. It formed another gap, and we're moving into the upper top of the Bollinger Bands, and we're disconnected from the 5 EMA. To me, what this signals is some weakness kind of stepping into place. I think this might be just a fake out until we head a little bit lower to fill these gaps. So I'm playing very cautiously right now at this particular point in time, and I've been very vocal about being very careful here because this isn't something that I want to trade. I need consistency in the markets, and this right here is not consistent, so I don't want to put my money on the line when it's looking like this. Here's the NASDAQ 100. NASDAQ 100 had a big green day today. It was one of the more, positive indices that was out there, and we kind of called this out because of the big bearish engulfing type looking candle, and then we had this hammer candle, and it reconnected down here to the 50, created a hammer candle, bounced from this gap that's still open, and we saw a strong day. But how much strength are we going to see continue to the upside after this big weakness? I think we'll probably run into some resistance right around 12,000, and then we're going to really have to decide where this market might be headed next. Maybe it wants to come close this gap. It tried it once, it got denied. Maybe it's going to go for it again. We got to watch this one very carefully, but 12,000 is going to be key level here in the NASDAQ 100 going forward. Here's the Dow Jones Industrial Average. Look at this, looks very similar. What's so scary to me is this gigantic gap from just 4 trading days ago. Well, 3 trading days ago, we gapped up huge, created this gigantic, just a monster reversal type candle, and we've been trading sideways. We had a gap up today, and then it filled the gap and headed lower, closed lower than the previous trading day, and it's right above the top Bollinger Band. It's right there, and we're disconnected from the 5 EMA. I think that what we're going to be seeing here is some sort of retracement in the near future. Now, that's not certain, okay? We talk in terms of probabilities, not certainties here. We just need to be prepared that these monster gap ups, it doesn't last like this forever, so we're going to have to be very patient as to what we can see. Maybe we get a retest of this bottom trend line, then we see another bounce. But until we really get some clarity in the markets is when we're going to make our next move. Let's go ahead and go over to the Russell 2000. Russell 2000, just a monster reversal type candle again, right? So we gapped up, then pulled all the way back. Then, we saw some strength, but look where we are. We're above the upper Bollinger Band, and we're disconnected from the 5 EMA, and we're oversold on the RSI. And yes, that is a negative divergence. Hardly. If we head up a little bit higher, that'll probably destroy that, but we'll still be overbought. Sorry, somebody corrected me the other day on that. They were like, no, it's not oversold, it's overbought. I always get those two confused, but luckily I'm dealing with a bunch of brains out there that can understand the difference. So yes, we are overextended on the Bollinger Bands, and we're overbought here on the RSI. And by the way, this big red candle was on a lot of volume. And it's going to be interesting to see here also how this one plays out. But this looks just like a gigantic rubber band effect to the upside. And it probably needs to take a breath here very, very soon. So be very careful going long here. If you're going to go long, look for areas of support. Could be at the bottom of this window or potentially at the 5 EMA. But you got to really honor your stop losses if you're planning on buying these dips, especially if it's really close like this 5 EMA, because what can very well happen is we can see just a very big move to the downside, which we've seen, by the way, in the aftermarket hours or in the futures in previous sessions from, just look back through history. So if, yeah, maybe the day it looks fine and dandy, but you don't want to get caught overnight to the downside, because then you might be stuck in that position and it'd be very hard to get out of, with a small loss. So be very careful out there. Make sure that when you are entering into any individual stock, that you're doing so with a very small position size relative to your portfolio. Never put in 20, 30, 40% of your portfolio in any one single stock or investment, unless if you're trading it. If you really want to hold something for the long run and you really believe in something, by all means do what you got to do. But me personally, I'm never going to take that route where I put in 20% of my portfolio and hold it for multiple days, because if you get a gap down, even if you have a stop loss on a gap down, you need to understand that, say if you have a stop loss that's, you're only planning on losing $4 a share, okay? Well, if it gaps down $20, it's going to stop you out and you're going to lose that $20 per share. So be very careful there. I don't want you to learn the hard way, but that would be a hard lesson to learn. So make sure you understand that. And if you don't, leave a comment or question or email me or something like that, and I'll try to get back to you as soon as I can. Here is the KRX. This is the KBW Regional Bank Index. This is this gets a good grasp on what's going on in the economy and the financials, right? These are the mom and pop banks, a little bit bigger, but let's just call them the mom and pop banks. We basically broke out of this inverse head and shoulders, about the ascending triangle. To me, I don't believe this. I don't understand why the banks would be doing good right now. It doesn't make any sense to me. I can go on and on about this, but I'm not going to. But from a technical perspective, what are we seeing? Well, it ran into resistance that we've seen right over here. Last time it broke above this horizontal line, and now we're starting to see some sort of reversal type candle take place. Are we going to retest it and move higher? Maybe. It did get overbought here, down 3% on the day. We have a couple gaps below us. It's hard to tell, but I can tell you this. When yields rise, it's better for the banks, because the banks, they borrow short term, they lend long term. It's very easy to remember. And what I want you also to think of is that whole big, not controversy, but all that information about Warren Buffett, when he started dumping bank shares and started getting into gold, $500 million into gold, which is relatively small to his portfolio. But he started getting out of bank stocks. And why would somebody like that get out of bank stocks? And the only thing that I can really think of is, well, if yields get crushed, right? And that's what's been happening. We'll get into the yields later. But if yields get crushed, how is the banks going to be making money on lending long term if the yields are so low? It just destroys their margin. So I don't know. I'm not nearly as smart as Warren Buffett, and I don't know how many people are, but in just simple basic terms, if you're moving out of banks, why would they be moving out of banks? Well, yields got crushed. Banks can make lower. It destroys their margins. Maybe that means that's why I get out of banks. It makes sense. Maybe it's much more complicated, or maybe it really is that simple. Let's take a look at the indicators here. First off, I want to show the VIX. VIX got crushed today, down 5.44%. Okay, what are we watching? Well, it kind of bounced from this area of support right around 2250. I'm still watching the lower Bollinger Band and this gap below us. This is inverse, right? So the VIX, the lower it goes, the higher the S&P 500 can go. The higher this goes, the more volatility it increases, and you can see the S&P 500 drip or drop. Drip, drippity, drop. Any Empire fans out there? That's where that's from. But we're going to be monitoring this one very closely. It's finding a little bit of support here, but keep in mind, when it gets overextended in either direction of the Bollinger Bands, sometimes you can see the stock market, the S&P 500, or individual stocks rally for a couple of days in whichever direction. So for example, if it gets overextended to the upside and you see it drip down for a couple of days, that means the S&P 500 might move up for a couple of days. And if it comes down to the bottom side and then it starts moving up, well, then you can see the S&P 500 move down for a couple of days. So we're going to have to monitor that closely. The NIMO, we've been watching this negative divergence on the McClellan oscillator. Okay, this is a breadth indicator. We look at sentiment, and we look at breadth, and we look at price action. Why do we do that? Well, it helps us get a good idea as to what's taking place in the market. It just helps us be more confident in what we are doing when we're putting our money on the line. And really what I want to show you here is 2018 looks very similar to 2020. I beat this like a dead horse. I don't think most of you need to hear this over and over again, but 40% of the people that listen to this video, so quite a bit, maybe even more than that, aren't even subscribed to the channel. So I would imagine that those people aren't subscribed. They're new listeners potentially. I don't really know. But, we made a high in 2018 on a negative breath. Then we fell. So down, up, high on negative breath. We went down, up. What's the difference here? Well, first off, after that, we saw a big, huge rip, negative breath. We're kind of looking similar here. Are we going to start tapering down on this bearish divergence? Mind you, so if we start seeing it rip down lower, I'm saying 3,000 to 3,100 could be a very good target if we start hitting this negative breath. Is that going to happen? I don't know if it's going to happen, but we need to be prepared for if it does, because then we don't need to get sideswiped. Here's the BPNDX. BPNDX is not showing us too much. However, it was overextended here to the downside, and then we're seeing a rip up. We are trending, we're above the 50 RSI, so we're at 55.83, so it's technically trending upwards. And, what I'm waiting for is potentially if we get overextended to the upside, that to me would signal a good opportunity to potentially short into that momentum, but we're not quite there yet. So I'm going to keep an eye on it. Keep in mind, we don't get overextended too frequently. It could go, like, for example, it went from April all the way till early September before getting extended down to the downside where it created a bullish divergence, and then we saw that run up, which we called out. So maybe it might not reach there for quite some time, but we're going to keep our eyes on it heading forward. Here is the S&P 500 with the CPC. This right here is interesting to me, the indicator below here. So this is just the S&P 500, and then right here what I want to show is really a couple of things. So first off, and I inverted this too, just to confuse you guys more. When it reached down to this level, and I just want you to pay attention to the more recent times, this down here really means that there's more bearish sentiment. Okay, so the lower this line goes, there's more bearish sentiment. The higher it goes, the more bullish sentiment. And what we do here is we look for extremes in either direction to really determine what a good contrarian point of view trade might be. So when it was way down here, at 1.3, everybody was bearish, which tells me, okay, now it might be the time to get bullish. Okay, so that means dumb money was buying puts, but the smart money was buying calls. Yeah, that's just a quick way to think about it. And then we ripped higher. Then in the recent months from July till November, where we're at right now, when it was coming down to about 1.0, that means that the dumb money was buying puts down here and here at the worst time. So for example, when it came down here to this 1.0, people were buying puts and we ripped higher. Right here, same thing. Boom, was buying puts, didn't get too, it just went straight up from there. And then now what we're seeing is it kind of extending lower, and we called this out already, multiple times. Money was buying puts at about 1.0 to 1.05, and now we're starting to creep higher. So what's interesting, sorry about that little, there we go. Okay, so now it's starting to creep higher. Now this is a 10-period moving average, okay? You can pull up the CPCE, the CPC, the CPCI, and you can kind of look at it over yourself and kind of just, or Google it to determine what that actually is. If you're unfamiliar with what that means, it's a put to call ratio. It helps us understand the sentiment of the market, and when sentiment reaches an extreme in either direction, I do the opposite of what the overall market does, because to me, when everybody's way too bullish, that means all the bull trade's been on, it's time to get bearish, and vice versa. So now we're starting to get bullish again, but we're getting bullish when the market's reaching an all-time high. So if we start ripping way up higher here, 0.80, 0.75, we start moving up into that range, that to me signals, okay, everything is way too bullish, it's time to get a little bit bearish here. But we'll play it by ear, and we have to have other things aligned. Never look at just one indicator. You can get kind of confused if you do that. Okay, let's look at commodities really quickly, and then we're going to kind of wrap this up. Commodities, I just want to point out gold, bear flag. Okay, still hasn't reached into my price target, which is going to technically be this lower blue trend line. Okay, and if it goes back below that, I'm going to look at this 200-period moving average, which is right around 1780, as low as about 1760, 1750, this kind of range. So if we get down here, I'm going to probably pick up a little bit. If we get down here, I'm going to pick up more. I'm going to have dry powder ready. I'm a very, very bullish gold in the long term. It's what I look at to protect my wealth, and it's real savings to me. If you haven't seen the chart that I posted a while back on Twitter where I show you, how much the median home is in terms of gold, and then you kind of see what it was like over the years. It was so interesting to me to see that, just in like 2015, if you would have saved gold instead of cash, well, your house would cost, your median, priced home in America would cost 11% more, but yet you would have a 40% discount if you were saving in terms of gold because of how high gold has risen due to, what can only assume is money printing taking place and, fear in the entire economy. So there's a bunch of different reasons as to why, and I'm not going to get into that whole thing. I just trust gold because it's been around for 5,000 plus years. Here is silver. Silver, we have a descending triangle, bear flag within it. I'm not too convinced on buying silver around these levels. Even at the bottom portion, I'm keeping an eye on 20, maybe a little bit lower than that, to be quite honest. Silver is much more volatile than the price of gold, so we're going to just kind of monitor this. Now, if we start breaking out to the upside, I already have a silver position that I got back in March, so I'm pretty happy with where I stand. If we ever get back to those levels again, trust me, I'll be buying it up again. But as I see it right now, my eyes have been kind of on gold. It's a less volatile, and I kind of want to look to ways to protect savings and wealth over the long course of time. The next commodity is oil. And what did we say? Well, it came down to this range. It looks strong. Then I said, okay, now we're reaching the top of the risk range over here, which is right around 42.50. And now it created, might be hard to see, but an inverse, you can call this a inverted, hammer candle at the top of the range. So now are we going to start get rejected and move lower, which is going to put, pressure on certain stocks and certain industries or sectors? Very possible. But what if we start breaking out of this level? Then we need to be prepared to start looking at stocks that can benefit from higher priced oil. But right now, we're at the top of that range, so we need to be very careful. The last time we were there, we held for quite some time, but then we started dipping down a lot lower. This inverted hammer candle makes me think that the price can potentially head a little bit lower, but we need to be prepared for if it does decide to break out. If we start getting above 45, hey, we might have some legs to this overall move. Let's take a look quickly at yields. I already know that, I already mentioned this, so I'm not going to get way too into it, but the spreads have been increasing. We're at 0.79, and then we're at 0.98 for the 10-year, still relatively low overall, but keep in mind, the trend is going up. Okay, so when yields go up, bonds, obviously, you're not going to get that much out of the bonds. You're going to see certain bonds like the TLH go down. You see the 30-year, it's at 1.75. We're starting to see some movement to the upside. That's good for the banks. But how long can this last? Really ask yourself, how long can this last? We're looking at resistance right up ahead. We had here in June, and then also right here in March where we had that sharp move to the downside and then sharp spike. Keep an eye on yields. Keep an eye on the bond market, because the bond market is very telling as to what's going on in the economy. They look, the big bond investors, they look at all the macroeconomics, they look at all the data, and then they price it into the bond market. So you don't have to be some crazy economist to understand what's going on in the markets. You just need to understand what's going on in the bond market after that data comes out. It's pretty crazy. Let's look at the dollar. The dollar found support at 92, not surprised there. Okay, we mentioned that. And now we're seeing it move up, got a little rejected from the 20-period moving average. Okay, is it going to continue to move up and put more pressure on the precious metals, or potentially even the equities market if it breaks above 95 and shoots higher? Now keep in mind the price action is way below the 200-period moving average. So the longer it stays there, the lower the 200-period moving average moves and the stronger downturn and trend it creates. Right now, the dollar is in a negative trend. It's in a bad trend. So we're going to have to see good trades take place and set up, which this looks more like a bear flag than anything. But once we start seeing positive trades take place, that can eventually change the trend. But as I see it right now, we have a bad trade, we have a bad trend, and it's just within this channel. Could be a bottoming pattern, maybe. But right now, it's more leaning towards the bears than the bulls. Okay, so let's be careful there. Let's wrap up my thoughts here with a conclusion. Okay, so what do we got going on? Well, still the market continues to be very, very uncertain. We're seeing big gap ups in the after hour session, in the futures. And then during the day, we just see moves up, moves down. So what do you need to do? I urge you to be very patient during these times, okay? Professional traders, they look at this and they're like, yeah, it's just not my time right now. Until they start seeing some strong momentum, consolidation, and some patterns that actually make sense to trade, okay? If you're a long-term investor, you can think of different strategies. But if you're placing trades and holding them overnight, this is where you need to be very, very careful with your money. And I've been saying this for the last week and a half. Yeah, you could have made a lot on these big moves to the upside, but you didn't do anything to, really, qualify to get that money. It was nothing crazy that you did. It was just the overnight sessions pushing the market higher. During the cash market, it's just been chop, chop, chop. So I urge you, if you think that these overnight holds and then you get in all this confidence, keep in mind the opposite can happen. You can wake up the next day with a monster gap down, which we've seen take place in February, where we've seen 800-point moves to the downside, and then all of a sudden it just rips lower and then the circuit breakers hit. That's very possible. So what I'm trying to tell you is, if you're making money, make sure that you're pulling profits, make sure you have your stop loss, make sure your positioning size makes sense in these environments. And I'm not doing this to scare you or to say there's going to be a market crash or blah, 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 or whatever the case is, or predict anything. But, if your goal is to become wealthy through investing and trading, just be aware, this ain't something that you need to be super fast at. It takes time, it takes patience, and only the very patient and the people that stick to a strategy are the ones that win, over the long course of time. You can be one trader, I made $1 million and I turned it into $5,000, and then I created this course, and then all of a sudden I lost it overnight because I thought I can leverage up all the money to make just this big trade. You hear it all the time. You heard it in 2000. You heard it in 2008. I used to post videos of people as the intro when they did this type of things, and then they get so confident and then it just kind of gets wiped out. That's not what I'm here for. I want to be as realistic as possible with everybody. Right now, if you hear anybody say, this is what's going to happen, I'm certain, don't believe it. Just do not believe it. No one knows what's going to happen at this particular point in time, and anything could take place overnight. We've seen the market move on vaccine news, and what was so crazy about that whole Pfizer vaccine news is look what the CEO did shortly after. Sold 60% of his shares that he owned after the release of this news. We're living in some weird times. So, just be careful and protect your money. If you got money and you're investing in your trading, just protect your wealth, man. That's all you got to do. All right. I think I've beaten that horse dead. Everybody have a really good day. Thanks for listening. Thanks for watching. And I will see you guys on the next Stock Market Brief.